Ladies and gentlemen, welcome to the 30th episode of the Futurum Equities Podcast. The Dirty 30. You got myself, Stocks Heavy Shy. We got Daniel Newman. How are you doing, Daniel? I know this was you were just doing your media hit in New York, so I don't know when you got back, but you were all over TV.
I was on the road a bunch this week. There's some TV, but there's other things in the works, some important stuff. You know, in between the media and the tweeting, there's real work to be done occasionally. I know people think this is probably all we do. It's just a full-time job inside of a full-time job. But no, it's good. It's been a bit of a crazy week. Last week ended on a bit of a high, after a really tough week. This week started looking, came out kind of looking flat. And then yesterday just kind of fell off a cliff a little bit. It's really unpredictable right now. There's you remember Friday, you're like, if it breaks this one average, I forget which one you said, was it the 21 day?
21 week. Yeah.
21 week. Sorry, 21 week. And you're like, I think we might be okay. And it broke through it pretty easily. And then, like I said, all week, it's just been a ton of fear. Fear in crypto, fear in AI, fear in jobs. I think they got the people shaking. How about you? How was your week?
I mean, it feels like it's just like the volatility is the new baseline in 2026. And I think that's probably what's catching a lot of people off guard, myself included, where usually there's a cause and effect. There's a reason this is driving this kind of pullback. Right now, I think we can't pinpoint a specific reason. So now there's this gap of heartburn and uncertainty or fear that nobody can really pinpoint what's driving it. And that's causing more spiraling to occur. That combined with, I mentioned the 21-week EMA level, QQQ is at 601.5 as of 30 minutes before market open. We have to close above 606 by today. If we don't, this is a character change in the market. And I think we're going to start getting technical traders to come in to play the downside. And as of this moment as well, I think the VIX, I'm trying to see where the VIX is. VIX isn't even that elevated right now.
It's like 21.
21. So like if you look under the hood, it feels capitulatory on certain sectors of the market. Like I think there's a lot of names are down 50, like Hims and Hers. It's still a great company disrupting healthcare. They have some like edges of PR issues, but like that's down 50% this past month. We have quantum names down over 50% the past 2 months. Space, like this is still the year of space. Like SpaceX is still going public in 2026. If they do, it's a 1.5 trillion. But you have Rocket Lab going from $100 to now $65 when nothing has changed about the business. So I think there is somewhat of a gut check a bit on something that has been maybe easy money or not easy money, the clear 2025 winners, assuming that was going to continue this year due to the administration, due to national security components on these secular growth themes, whatever it might be, it's drained a bit.
Hard to not think, though, so much of this sits in crypto.
It has to.
There's so much of a sort of cascade. I think we talked about it last week a little bit. When liquidity gets pulled out of crypto, it just feels like it flows to better and better assets in terms of selling pressures. It's like the Vegas bets are crypto. Everyone's got these big, high risk, high return bets. Everyone expected in this administration that crypto would be really friendly. I mean, no one would have thought that we would be back to kind of the levels when Trump entered office with all the crypto friendly sort of ideology that sits inside this administration. But here we are. I mean, Ethereum under 2,000, Bitcoin around 65. Solana's down 60%, 70%. And, I think every time crypto starts to show a little bit of momentum back up, the market comes with it. It's like you see, Bitcoin jumped back over 70 at the end of last week, and all the growth stuff came back up with it. And then this week it sold off again, and all the growth stuff kind of fell off with it. There's just so much correlation there. I can't tell exactly what it is, but it just feels very much, there's just a lot of it's aligned. A lot of
it's good. I think it's a lot of these big funds, they have a mandate, get more crypto exposure, get more AI exposure. I think those things are correlated when you get a mandate of these big themes of the future. Like, we want to be positioned in digital platforms, aka cryptocurrency. We want to be positioned on the new infrastructure, the new economies being built on. So, like, if one part is clearly the carnage is just clearly there right now in crypto and just breaking key level after key level, and there's no real V shape. It's just head fakes and new low. That's going to cause some covering that's going to occur. And what you have to do when you cover a position, you probably have to de-risk elsewhere that you were just also adding during that crypto ad you did. So I think that they're all connected. Risk on is just one large bucket: AI, space, crypto, quantum, etc. So I think I hate that it's open 24/7 because like during the weekend, like I do look a couple times a day at the crypto markets to see, like, is it falling apart? Is it stabilizing? To give me a better idea on what Monday open is going to be like. But again, if you're a long-term investor with a long time horizon, I think crypto has become so important, so big that it's too big to fail now. Like, I think I get the ideology elements of it, but it's just as big as silver. It's just as big as gold. And I get that it's not as tangible in the real world, but the concept is very real and permanent.
What do you make of that, though? Gold and silver have fallen off a cliff too. So it's like the risk off investments that everybody was kind of, saying to the moon. Those have sold off at like an incredibly fast rate, like almost like crypto.
I know
silver on like 30% a day last week.
So silver has been acting like a growth stock the past, because there's an AI element to it now. So I think that there is a riskier on components than it's typically behaved. Let me see gold stock charts. What's gold been doing? Yeah, I mean, gold's actually holding okay. It's like down 8%, but yeah, I mean, there's clearly there's a de-risking across the board, and I do believe it feels. I know a lot of people want to say it's manipulative, like there's something bigger driving this for whatever reason. I do feel like it's very structural, this pullback, and that's the issue with, like, oh man, what's happening right now that's manipulating this pullback. And that's why I'm being a little defensive right now, and I'm holding my key level 606 on Qs. Like, that's when I really will start getting more aggressive. But as of right now, I do have some hedges because that's my one rule. But I might have to tighten my book up. That's typically what I do on pullbacks. I have a basket of 20 names. I want exposure in all these different themes. But if we are clearly pulling back, having a strong correction, I'm going to tighten towards my higher conviction names. And I think that's healthy. But yeah, it's weird. It's totally weird. And I think that AI go back to AI, because I think AI specific is very whiplashy. I know you and I talk about this a lot, but I think the software sentiment is just so absurd. It's almost becoming an ick for me, where I read online like software's going away forever, all of them, blah, 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 blah. When that's not the case at all. I think you and I both also agree on this. Like 95% of software will probably be valued as a legacy layer of the new AI stack. Like, they're not going to go away. But right now, when a stock goes from 20 times free cash flow to 10 times free cash flow, that's just a company that's going to be there, but nobody really wants to assign a premium to it. But I don't know. What's your updated take on software right now?
Yeah, I mean, look, you spend a week answering the question over and over again. It hasn't changed for me. It's not going to be completely eliminated, but what's being done with some of these AI platforms is pretty impressive. There's definitely an importance to sort of help the market understand the moat, understand what's sort of guiding, this fear. And I think the biggest fear comes from the fact that we get stuck trying to assess what's going to happen based on the current circumstances, meaning based on what AI software can do right now, based on what Anthropic's capable of and showing right now, and not thinking about, okay, like a month ago, we didn't know about cowork. wasn't a thing. And then it was a thing. And then all of a sudden people are looking at what you could do. Because, right, I mean, like Copilot was kind of being looked at as like, oh, it's heavily sold, but low utility. CIOs aren't super happy with it. They're not getting the value out of it. Maybe this AI thing's overblown. And then all of a sudden Cowork came out and people are like, holy crap, all this stuff I kind of want to do in Copilot, you can do with this Cowork tool. And obviously that's just like productivity software. But then you, of course, you kind of go up into some of these SaaS layers, and then you see like, a journalist creating their own Monday.com on a Monday morning, and it works, and you go, wow, it can do this today. And that's probably the biggest thing that in my mind that, sorry, my voice keeps going away, that requires some consideration is just the change is happening so fast that we go from kind of like, what could this technology do to what will it do? I mean, I saw this great video, I shared it this week, of like of kind of video creation with AI between like 23 and 26. And it showed like Will Smith eating spaghetti. Have you seen that one?
Yeah.
Like what I'm saying is like, you watched it in 23 and it was like a bad looking cartoon. You watch it in 26 and it looks like they're making scenes out of movies, like high quality film, cinema, using just description. I mean, the speed of which this is changing is probably the one uncertainty that people are a little bit uncomfortable, because like if you look at what AI can do today, it can't replace core enterprise applications. You can't rip out all of that proprietary data, the rules of these businesses, compliance and governance, pervasive management and updating of the software, and just be like, okay, let's vibe code this. There's too much there. But having said that, like I've said all along, like most people don't like their enterprise software. They would prefer a semantic layer that they can interact with, that they can quickly see reports. They want to talk to their tools. And that's what AI platforms have given us now. You can go on Anthropic or ChatGPT, you can just talk to it. You can talk to it about what you want to build. You can talk to it about what you want to know. You can collaborate with it. You can iterate with it. Most people that use AI well, you understand it's very iterative. There's no one shot with AI. AI is like sitting down with a strategy consultant and you go back and forth with it and you talk to it until it gets to where we want it to be. But it just keeps getting better. And I think that's the problem is as it keeps getting better, what are the new rules for software companies that are going to be required for them to stay competitive? And that to me, it comes down a lot to, how do they work with AI? Meaning, how do these companies apply it to their own solutions? And also, how do they recalibrate their economics? Meaning that like seat-based SaaS is like over in a consumption-based economy. By the way, in a company that might have 1,000 employees, they might have 100,000 agents. How do you charge for that? How do you make money on that? So how does this Salesforce, ServiceNow, Microsoft, Monday, Workday, any of these software companies, how do they charge for AI in the future? Because it can't be the way they've historically charged for SaaS in the past. And I think until that becomes a little bit more clear to the market too, it's harder for them to sort of build the spreadsheet to understand, discount cash flows, future free cash flow, and then therefore set multiples. So I think the re-rating is going to be there until more evidence appears.
Well, I also think the re-rating is fair because, again, the market is a forward-looking mechanism. I think you're seeing the potential on Cowork, for example, like all the new experimental funds is going to go towards these agentic offerings. Like, it doesn't matter if it's going to stick, but you're going to, that the value or the profit pool is now shifting to these kind of companies where it's not going to shift towards the original software companies because you know what it is. And so far, they have not created an AI solution that wows their customers like Palantir has. That's why Palantir is an N of one. Everyone else is still trying to figure out how to provide this AI offering that will wow their clients. They are still figuring that out. But right now, you're clearly seeing Anthropic, like they had a ChatGPT moment, and you're seeing lots of Cowork-like solutions out there that are clearly solving something brand new. And the beauty of them, they're software agnostic. And I think you were trying to get at that, Daniel, earlier, where I think there's going to be a new open source environment for the new AI agentic stack where nobody wants to be closed off with this specific software anymore in your organization. You just want this it could be some AI agent, a massive one that takes snippets of every single software into whatever internal use they have, and that's what they pay for, that massive AI agents. They don't want to really pay for these stupid seat licenses anymore. They might not want to pay for like, oh, you want to upsell me on this UI change? Okay, I'll pay 10% more. Like those days are over. And I think that business model re-rating right now we're seeing in software is actually fair. The only disagreement I have is all of them shouldn't be treated as one. And that's where there is going to be opportunity in this pullback, because if you have any software designation associated with you, you're experiencing the pain. Eventually that's going to change. And I think it's going to take a couple quarters for that to change, because the ChatGPT moment just happened in January or the past couple months. As time goes on and they see the fundamentals improving, they see acceleration in key KPI metrics that shows that this is a tailwind. It's not an anchor. But right now, across the board in software, you're seeing deceleration. Eventually, it's like gloves on. Are you going to win, or are you just going to survive? The companies will answer that question for everyone eventually, but it's going to take time. And that's why I think a question I have for you as well is, do you think the software spend TAM is going to increase in 5 years, or is it going to stay the same or decelerate?
So the TAM for seat-based will probably decrease.
Mm-hmm.
This is where I talk about the economics, is how much software will agents consume?
Well, sorry, let me reframe that. Do you think IT spend will increase?
IT spend, yes.
So
it has to. It's going to come at the cost, in my opinion, of a lot of OpEx and human capital. I think as companies figure out, 24/7, 365, no benefits, doing all the monotonous work, it's all going to be done by IT spend. So yeah, I mean, there's no doubt that increases. It's just where does the consumption layer take place, and who's getting that revenue? And it's not as obvious. Like if you put like a Anthropic or ChatGPT wrapper that sits on top of, a bunch of databases, Snowflake and Mongo or SAP and Oracle, right? How do those companies that have all that really critical enterprise data, how do they change the way they monetize in the future?
Mm-hmm.
How do they make sure they're sticky, meaning that data stays there? Does it move to a different sort of data bucket where data could also be stored? Because a lot of it, like in the past, is data systems have been about like the data has to be able to be read, and systems weren't that smart in the past, so they needed like structured data so that it could be read and understand at a line level. And now AI can look at a massive unstructured data and make sense of it pretty quickly. So kind of how data is accessed is going to be really interesting. I mean, hardware is going to be the ripper. I mean, hardware is going to just continue to just fly. But like software is just it's in this interesting inflection where that's where I said I think what we're seeing is we're selling into uncertainty. We're not selling into no use. The use is still there. They use it. And by the way, most of these SaaS companies are still growing. Demand is still pretty stable. I think there's outliers there, but I think what people are looking at, like you said, it's forward looking, and they're just like, I don't see a situation in which A doesn't keep getting better and B doesn't start to be cannibalized as a byproduct of that.
Yeah, I mean, I think the market's truly pricing in the future's uncertainty. That's all you're seeing right now, and that's what free cash flow multiple is at the end of the day. You're underwriting that you're willing to see years out how much cash flow that they're actually going to produce. Right now, at the rate that AI is kind of trending towards, I don't know how anyone can really predict where it's going to look like in 5 years for a lot of these names. Like you just can't. And AI is so disruptive. We've never experienced it before. That's really difficult to even predict what's going to happen in 2028. But like the hardware side, that is somewhat predictable because we've had multiple revolutions, and there's actual demand right now. You're seeing in the contracts, you're seeing like the actual TAM being experienced in their fundamentals. That's not as forward looking or risky as a software component. But going back to my TAM question, I think that's why I truly believe the IT spend for software is actually going to expand in this new AI economy. Only a handful of software names are going to capture the bulk of that. So there's going to be somewhat of a scarcity premium if you truly prove that you will be a winner. That's why Palantir, I get the evaluation right now on Palantir. Nobody is doing AI better than Palantir. Nobody. Like, I'm not just talking.
Burry said they don't do AI.
He doesn't understand technology, in my opinion. I think he's like not a tech person. He's trying to wear a tech wrapper around traditional metrics. It's fine. Like, we all have our own lanes. He's a genius.
I just thought that was funny. I mean, there is the difference of the people building AI and the people applying AI, and Palantir is an applying AI company. They apply AI.
Well, they also own their customers' data. That's the important part too. Like, there's a control.
But they're applying AI to the data. They're not necessarily building models per se.
Yeah. I know. That's why it's like, Burry's whole argument is like, the whole point of Palantir is like, okay, who cares who wins the LLM arm race? Whenever LLMs become a commodity, that's only going to boost our ad value, because we are the ones who decide what you should do with these outcomes from these LLMs. Like, again, if you're a customer, you hear all these ROI cases from Palantir's offerings in your competitor. You're going to, and the CMO, COOs, CEOs, CTOs, they all talk to each other in their circles. Like, you think they're competitive, but they're just there's like a club. They all talk to each other. So they're going to be willing to experiment with spending 30, 40, 50 million a year on Palantir's offering, because they see that they deliver and they don't have to handhold them, because all they do is Palantir goes into the room. They talk in their pitch, in their pilot, and they say, like, what do you want AI to do for you? And they just do it for them. And they monitor it, they update them, and it's just continuous, autonomous. It's such an insane offering that they're positioned perfectly for the AI economy. So if I do believe that the software TAM is going to increase in enterprises, I have to believe that Palantir's TAM is only going to expand when everyone else, I just don't know what they're really going to be offering that's that much of an ad value. Like you mentioned, like it feels like they're building BI tools on that are wrappers for something else. And that's very uncertain. It's like, I don't know. It's just too difficult. The unknown won't go away anytime soon. And that's the tricky part. That's why I've said since last year, software is a 2027 story. It might not be a 2027 story. It might be 2028, but it's super difficult. I wouldn't base your decisions on valuation, because what's a good one? I want to say Monday.com is a great example. I think Monday.com is like, you see no proof at all in the fundamentals that this should be eroding the way it's eroding. They're trading at 13 times free cash flow right now. What does that tell me? That means that the market is willing to underwrite this business 13 years ahead of where we are today, that they're going to actually be able to produce cash for your investments. For Monday, I truly don't know if that's going to be the case, the way AI is like innovating at this pace. I don't know if maybe 7 or 8 years down the line, it makes more sense. If that's the case.
A really good question about a Monday is, what is the moat? Meaning, when you build a tool that basically points at other tools and then creates like a workflow, this is like the absolute epitome of what you can do with vibe coding. Like, show it an interface you like and say, hey, I want to build something that helps me manage my project. And you can kind of talk it through the process of that. And it can build something that works pretty easily for that. You know, the difference of Palantir sits on the world's most rare and unavailable and specific specialty data, meaning the data that they're able to get access to do what they do, no one else has access to. It's not available to any of these models. They're not going to give it to OpenAI or Anthropic. So they're basically in this little bubble. That is completely their own world. And so that's kind of the unique thing about like an Oracle or an SAP. These companies have the data that run the businesses, their supply chains, their customers, every transaction. You know, the money moves on the rails. Like, it's not the same thing as like a tool that's kind of like, hey, you know, I just sold a new consulting project. Can you create a little like 5-step project program for me where,
Yeah.
I can keep tabs of my interactions. So you go up the stack, and I think there's kind of different parts, workflows, like this is why I like ServiceNow, ERP, CRM, HR. You kind of go down, and it gets further from being super proprietary and closer to being something that you could sort of build on the rails of a vibe coding platform. And if you look at that and you kind of base your investments on like how much really unique proprietary data, and then, the only other question I ask is how sticky are these tools in the enterprises, meaning how much of sort of a tribalism are there around these tools inside of enterprises? Because, there's entire teams in a lot of corporations that basically stand up and run the enterprise resource planning. They run the CRM tools. And I'm not saying they won't get ousted at some point, but right now, someone that actually knows something above them is going to need these people to actually help them basically sign their own death certificates, because these are the people that run the businesses. And these people are very protective of that. They're not necessarily going to be like, oh yeah, sure, we can hack out a CRM that's, we can pull out Salesforce. I mean, these people go to Dreamforce every year. They put on the costumes and they this is like their big moment. It's like their concert of the year. So there's a lot of like kind of human collaboration in terms of their own extinction that has to take place before all these enterprise tools get taken out.
It's like during the whole Hollywood strike, like these writers were getting replaced from AI, and a lot of these writers had to take jobs working for these AI companies to strengthen their model for them by making the edits necessary. Like, unfortunately, Kaplan's about to get brutal, guys. And it's going off your point on the CRM. Like, I've actually been like having this conversation in my head on trying to figure out Salesforce, because I do believe a systems of record element is going to be very important going forward for software companies. And Salesforce does have a systems of record component, but what's it stopping from like an organization having an AI agent just pull all the data for them from their Salesforce into whatever their internal organization is that they're using for AI agents, and then go from there? Like, I feels like Salesforce is too vulnerable in that way of like someone can suck up all the stuff they need and then still have that license, but it's not going to be per seat. It's not going to be like it's going to be reduced by like 80%, but they're still going to get all the information they need because they have an AI agent doing all the monitoring for the client information, etc. Like, what's your take on like Salesforce specifically?
Whoa, am I seeing this right?
What?
Okay, no. I was just in Yahoo and I saw NASDAQ started out, opened about 23 points down. Market just opened. Just was curious. I saw it down 460. I'm like, holy crap, did it come out? That was yesterday. That was like the yesterday close. But yeah, we're coming out cold. It's selling off the opening bell is selling. Just a quick breathe. Not massive, but dropped down about 60 points and then on the NASDAQ. Going to be an interesting day. We'll see. I mean, one of the things I did see over the last even year, I used to call it the fuckery, but like the pre-market really doesn't mean shit. And what you see at the, oftentimes you'd see these really green mornings and you'd be like, oh, it's looking like a good day. And then you'd see this hard selling. And then on the other side, you'd see these really red mornings and they'd end up being really green. I think there's a lot of kind of low margin, nonsense that goes, or not low margin, low volume nonsense that goes on.
Yeah.
I just thought, have you thought about like how crazy it would be if we had 24/7 markets, all of them? I know
I'd be miserable. I think that's the dumbest idea. One of the more degenerate mistakes that we could ever make.
Yeah. It feels great when you're in a massive bull. You're like, yeah, keep them open. Let's go, But when you're in a time like this, you're like, please close Friday, like half day. Close the market.
What's interesting right now, though? ARK is up 2.5%. So there is a risk on behavior right now in the market, even though the big tech, nobody just wants to be in big tech. I think that's a good transition to talk Max 7 right now, because again, compute is the new moat in this new digital economy. Like, you hear us say this every single week. So like, it's ridiculous that these companies are getting penalized for just getting all the compute necessary in order for them to maximize their AI initiatives. Like, that's just absurd. Like, if you just 1 + 1 = 4, essentially, it does not make sense to me, the market reaction. But I think there's a component of like, they don't want to be participating in dead money, because this is an investment year. Clearly, if you look at the 600 billion plus capex for Max 7, like for not Max 7, just Big Four, their capex growth is exceeding their earnings growth. So typically when that happens, not much is going to happen in the stock price in the near term. So people are trying to find alpha elsewhere. That's fine. But when you have a Meta, they just guided the 30% growth. It's at that scale is absurd. And they're trading less than 20 times earnings because they're getting penalized. Like that whole earnings gap up just got filled. And it's even lower than it was before those earnings. So you're getting that earnings for free now, essentially. Like, what's your take on this exhaustion of labeling Mag 7 Capex as like the bad guy?
Well, I mean, they're just looking at all Mag 7, look at NVIDIA. NVIDIA doesn't have big Capex. NVIDIA is the biggest beneficiary of a $700 billion commit, right? And probably 50% of that goes to them. The trade stock hasn't moved in 6 months. I mean, it's basically been range bound, and they've got a massive order book. They are the biggest beneficiary of this entire transformation. I think we've, at least if nothing else, this kind of AI will eat the world panic has shown one thing. It's not a bubble. You can't be both things. It can't be both things. It can be one or the other. Either AI has no utility, and this is the biggest waste of capital that's ever taken place in the history of Earth, and this is going to all explode, or this has some real utility, and the race to spend is on because the future of the economy sits and rides on top of this revolution. It's one or the other. I mean, that doesn't mean there can't be shitco's that blow up, that we're kind of riding the wave, but as a whole, like the capacity, what are we seeing? What kind of signs have we seen that maybe indicate that these big four spending makes sense? We saw TSMC's numbers. That was definitely a validator, right? The TSMC's Capex expansion. AMAT yesterday had earnings, Applied Materials, another big semi-cap play. Their numbers were good, but what was probably the most interesting thing I saw was when their CEO said in the earnings comments, $1 trillion in semiconductor spend could be this year. They think semis could be $1 trillion this year. By the way, that was like something that I think people had forecasted by the end of the decade. We could see this pulled forward to 2026. This means that the arms race is absolutely on, and that the players that know what is at stake. It's an existential risk. It's extinction risk to these companies if they do not protect their moat, that they will not be the Mag 7 in the future. So, I mean, I guess maybe there's a discount on that maybe they won't execute. Maybe people don't want to pay anymore for that, like saying, hey, I don't know if all this spending will get them to the place that they think it will. But I'd be much more nervous if they weren't spending. Go ahead.
No, I was like, if they weren't and they were just focused on getting 4% back on their cash, I'd be like, okay, they don't see the potential of this disruptive technology that everyone is like, this whole market. This whole Apple is a good example, but this whole bull market is because of AI. So if you see the biggest beneficiaries of AI aren't investing forward, they don't see what the rest of the market's seeing, and the market will just go back to whatever was pre-AI. So I think this is like absolutely healthy. You absolutely want to see this. I also want to go back to your Mag 7 point of like, it's just so interesting because you mentioned that they all are fighting each other, and it feels like they used to have their own like moats. Like, for example, Microsoft had productivity, enterprise productivity. Google had search. You had Meta, social network. Amazon was logistics, e-commerce, etc. Like, they're all fighting for super intelligence or AGI. So now they're competing against each other, and I don't think I've ever witnessed, or I'm too young. I'm 32 years old only. I don't think I've ever really studied or read upon any kind of instance when this amount of companies with this much cash are fighting each other for one thing. And we just don't know when that will end, because in theory, they're just going to keep fighting until someone solves AGI. And I don't know about you, but like, I don't think AGI is any years away at all. I think it's way down the line. So in theory, there could be years and years of this spending spree that's going to benefit hardware for a long time, because it's not going to be cyclical. Like, I think it's, I don't know, what's your take? Like,
do some quick math though on it. Like the build out, 8 to 10 years, maybe minimum to get to where we think, I think Jensen said 8 or 9 more years. I don't think it ever really stops because the generation hardware improvement cycle, it never got longer in history. It's always been either sort of stable, like the compute era, or this GPU era where it's actually seen consolidation to shorter and shorter periods. As better and better technology becomes available, it's going to be more energy efficient. We're not going to see less token utilization. We're going to see more with every generation. And by the way, we really don't even know. Like the reason I think compute is the moat, and I mean, of course, you could look at energy and everything else, but the reason I think compute is the moat is because these companies need the flexibility to be able to pivot to whatever whatever compute enables to be done. Meaning having more compute to be able to enable for the next technological breakthrough is going to be an advantage. So Zuck doesn't want to have he doesn't want to be under resourced in his compute. He wants to make sure that he has that level of control. And then again, like I said, we're not even really adding in the physical part of this yet, the build out. Like we're really still just thinking about data center, and we're thinking about sort of digital outcomes and things that you can do all online, but we're not thinking about the physical world and all the AI that's going to come into it soon. Look at the expansion of Waymo. Look at the expansion of Robotaxi. Look at the expansion of robots. Look at like what happens when all these things come online at the same time. There's going to be an absolute monstrosity of compute that's going to be required to do these things. So I just think, obviously, some of these Mag 7 names have had great runs. Like Google had a great run. I mean, it's pulled back a little bit, but like it was an incredible 2025. So, seeing a little bit of a sideways motion isn't that uncommon. NVIDIA had an incredible multi-year run, and now it's seen a bit of a sideways, but what is it? Still valued over $4 trillion, right? I mean, it's still an incredibly well-valued company. You and I had we set our ideas for 26. We both liked Amazon and Meta a lot. Like I still do. The Amazon timeline might get harder with a $200 billion Capex commit this year. Than it was if they were maybe a little more conservative on cash flow. But at the same time, like if anyone knows the history of this sort of AI transition, those that bet big and spent big on AI capacity early on have done better. Meaning both Microsoft and Google Cloud did well better than Amazon in their growth rates because they basically spent the same amount of Capex in the beginning. And so now Amazon, I keep saying they've had to play a little bit of catch up in terms of building enough capacity to be able to scale their AWS business. And their AWS business is their cash cow. So I think they're investing in the right places. And I still think they've got this huge engine to turn on at some point with physical AI. I mean, they are the epitome of a company that is designed for physical AI. They've already got it in their warehouses in some ways with robotics, but, drones, autonomous delivery vehicles, robot deliveries, robots in the factories. They're in everybody's home. They're part of your sort of just life flow, I call it, like your life flow of ordering things. Like we walk in your house, hey, I need milk, I need cheese, I need a new sofa, I need a TV, whatever it is you need. Like you just talk to Amazon. It's pretty. I
think Amazon is an issue that they just don't have a showman CEO. I think it's one of the, like that was Google's anchor for a long time. Like they were just like the most quiet operators, and then we're just gonna like just show you all at once, and it's gonna take off. Like that's always like they don't like to reveal their cards before, so that everyone else doesn't see it. I think Amazon is one of those names where they are quietly doing something very disruptive, and there is a combination of frustration on being an Amazon shareholder because it's gone nowhere for a long time. When you've seen names like Google Cloud all of a sudden just produce 48% numbers, and they are just at this pace, who knows how close they're going to be as like Google Cloud and AWS. Like, I don't think it's at all going to be close because AWS can actually finish the year growing 30% this year with the amount of CapEx they're spending right now. Like there's a clear backlog, and they're clearly going to have that monetization tail come through because they're going to get all the tools necessary. So like there's a real world that AWS can go 30%, and everyone can like shoo now about AWS conceding their top cloud spot. But it's just,
which by the way, they didn't concede it. They just slowed their growth. I mean, they're still the largest, but in the GPU cloud era, they aren't seen as the leader necessarily, even though they're the largest cloud company by far.
No, I think they fumbled. Like you mentioned earlier, like 2 years ago, AWS CEO fumbled a bit. I agree.
He lost his job for it. So, I mean, he lost his job because, like I said, he just pivoted. He was actually on the right track. Everybody's now lauding the CEOs that are building their own infrastructure and not being 100% dependent on NVIDIA. He just did it before they were ready. And he paid the ultimate price.
Oh God, market's definitely dipping now. So yeah, this is not looking like the savior day. I was trying to get in some hedges as you were talking. Right now, it did not fill, which is frustrating on some options, but it is what it is. Yeah, so CPI didn't save the day. I thought maybe like last week we had Friday essentially not save, but it provides some relief hanging into the weekend. And we're gonna have a V shape to close above 606. So like that's why I'm looking for some hedges right now, because I just don't see a 2% swing in the market, especially on a holiday weekend. It's closed on Monday, guys, so be aware of that. A lot of people don't want to hold this kind of pullback into an holiday weekend just because you never know what's going to drop. But going off of the Max 7, I do want to ask you this as well. Someone in my community asked me about Microsoft, and I think that Microsoft's interesting because they had such a massive first mover advantage in AI through their relationship with OpenAI. Their productivity suite and enterprises is positioned perfectly for AI to create this massive tailwind for them. I think we're continuous. Like Cowork is what Copilot should have easily been way earlier. Is there a reason? Like, I think right now Microsoft's getting penalized with their valuations, the lowest it's been in a long time, because they feel like they're like with the rest of the pack when they should be miles ahead with their first mover advantage. What's your take on Microsoft right now? Because is this, like, a lot of people ask me, is this a buying opportunity? Because clearly their enterprise mind share is not going away, but they're getting penalized for something. It could be Sam Altman, it could be lack of progress in AI the past year or so. What's your take on it?
It's interesting. First of all, I think the penalty to Microsoft is mostly related to its OpenAI relationship. Mm-hmm. Everything that has been attached to it, I call it toxic. And despite OpenAI's sort of high valuation, clearly the private markets and the public markets have a disconnect on how much they believe in OpenAI's ability to succeed. And we'll see what happens if OpenAI goes public. But what I mean by that is, like, whether it's been Oracle, whether it's been any company that's announced a big partnership with OpenAI, like, it has not done anything positive for those stocks in recent times. And so when you looked at what happened in the earnings, Microsoft announced this massive backlog, twice the size of Google Cloud or AWS, but half of it, like 45% of it, was OpenAI. And I think the market just absolutely hates that high dependency, and I think that's a lot of what a lot of why they're being penalized. I do think there's some outside risk. I mean, Satya was actually the most vocal about the risk of SaaS, right? Even though he has a business that's sizable, I mean, he kind of started that downtrend. When he said that comment about the deprecated databases, CRUD databases with logic on top of them, right? So he sort of, in some ways, sort of signed their own, sort of proverbial death certificate in that topic area. Like, he's like, hey, and I guess because they have all these other businesses, if that goes away, they see other opportunities for growth, and they're not as at risk as, say, a pure SaaS company.
Totally.
But I mean, I think Microsoft's well diversified. I think they are sticky in the enterprise. But I do think that people that I've heard this a number of times from enterprise IT leaders and such that have played with Cowork, and they said, like, this is what we wanted Copilot to be. Will Copilot get better? Yeah. Will enterprises quickly move off of Copilot and over to Cowork? I don't think so. I still think enterprises' own ability and speed to make change with software is a big part of why this narrative will take much longer time to play out than most people think. They just don't move that quickly. And, getting an enterprise with 50,000 seats over to a new piece of software that's been, by the way, completely tied into all their other systems, and everything has been built and wired to work together, you're not going to vibe code that. There's real work that'll have to be done. So small businesses can move super fast. Big businesses, you were a big business guy. Like, how quickly did you see when you were in United, like, how quickly did new software rollouts take place?
Oh my God. United Healthcare. First off, I pitched the CTO about Palantir 3 years ago for United Healthcare, showing them everything they're doing in Tampa. They would not, like, take a second meeting with me. They're just like, it's too much of a black box. They wouldn't even entertain like the exercise of what it would look like if you adopted it. So like to answer your question, big organizations, they don't take a big leap of faith in disruptive technology because they're sticking their neck out. Like if you stick your neck out as a CTO and it doesn't work out, you're ousted. But if you play the game and just like what has worked historically and you'll just like slightly adjust or do something slightly different.
Something funny. NASDAQ's up 17 points now.
Oh my God.
I'm not saying
what 1% swing. That's crazy.
I'm just saying
that's a 1% swing. So that's huge.
This is what I talk about with like the morning fuckery is like, you just really don't know anymore.
Wow. Software's leading it. That's actually very interesting. Snowflake's up 5%, Crowd's up 4%.
So in a minute, everybody out there, if you want, start dropping some questions. You and I will go over the minutes here. Before though, I want to talk about HIMS because I'm the guy in HIMS. I'm the guy that posted some stuff about it this week. I had a lot of hate mail. You know, I have a lot of support too. I mean, the post got a ton of likes and views, and there's a lot of people that agree with me. You know, by the way, my position in HIMS is about 1 to 2% of my portfolio. It's not a huge position. I bought early. It was up a lot. And now I'm down nominally. I think I bought most of my position about $25. So I'm not like getting killed, but I was also in it when it was 70. So I was feeling like a real winner at one time. And I actually got longer. I didn't buy a lot of common. I did buy about 1,000 more shares, maybe when it hit 19. And then I wrote some like sub $5 put spreads or 10 and 5, like really low. I think I did 5 and 4. I sold the 5s, bought the 4s for like mid-year, and I got 40 cents a share. So basically existential risk, like maybe it goes bankrupt. And then that's pretty much the only way I see losing in that position. But okay, so there's a couple of things going on. One is personalized medicine, I think, is disruptive. And I think the ability to deliver personalized medicine at scale is disruptive. I think they really screwed up their PR. I think the whole thing about actually specifically saying the same ingredient and mentioning another drug from a well-known brand was a huge mistake. I think this is a company that takes shots and gets some well. It does well with some and gets really wrong with others. This one was really wrong. I think that the idea of personalized dosage of GLPs is a really important thing. And this is someone like I'm invested in a peptide business that's like personalized medicine. I believe in it. It's life-changing. The dosages that most of these pharmas give you, like the standard dosages that you get of these Ozempics, that they call it Ozempic face, that people lose all the weight and they look really gaunt. Like these drugs are too strong. They deplete muscle. They put this death spiral of your body's ability to lose weight on its own, because instead of slowly losing fat, you actually lose like lots of like muscle tissue. And I do think that what HIMS was trying to do could be really valuable. And so I really like what they're trying to do. I don't necessarily like how they do it. At this point, I just think it's worth a shot because it's so cheap and it's so beaten up. But I would also say like there's an absolute chance that this company will screw up and take themselves to zero. Like they are just that wild in terms of their decision making. So it's not for the faint of heart. It's not a thing I would recommend, even at this price, as a great idea, unless you're willing to take risk. But I do think there's asymmetric upside because remember, this isn't just a GLP company. They do ED, they do hair, they are doing testosterone. They are looking at introducing other peptide therapies, and they are pretty much the only public vehicle for that kind of investment in personalized medicine at scale. And so if you do believe in that, that's really where I stand. But like, I totally think they've made some real mistakes. And they're paying the price for that right now. But again, I don't think I think people are betting that GLPs is not a huge percent of their business. So
I hear you on that. It's like it was driving a lot of the narrative for a while. I think what's being re-rated isn't the business model; it's more of the governance. Governance risk now.
You're being re-rated for risk and decision making.
Yeah, it's governance, all governance.
And so anyways, I'm still in it. I'm not recommending it to the outside, but we're not. We talk about what we do, what we like. But that's why we say this is you do your own, do your own, your own research.
By the way, I think before we get into the questions, because I want to leave 10 minutes, like what you mentioned, the position sizing, 1% to 2% slots are meant for speculative moonshots. Hims and Hers is trying to disrupt a massive, archaic dinosaur industry.
Yep.
They're going to make some mistakes because they're shooting. In order to do that, you have to hit a home run. They made a mistake. Now they're experiencing the pain, but position sizing, like what?
By the way, one of my larger positions in high risk speculative is actually a pharma company, Viking, which actually is making what I think is the best.
We didn't get to Viking today.
Oral. We don't really talk about it, but they went straight to phase 3.
Yeah,
that one's looking really juicy. Multiple reiterations at $100 or so price targets, and it's looking like a wonderful acquisition target at this point because its readouts are coming out great. So it's like I said, I'm not saying pharma can't succeed. I'm just saying Novo doesn't have a great mousetrap. There's better mousetraps out there, and there's companies trying to disrupt the way healthcare is done. I think both are interesting, and you can kind of play both sides. You could call them hedges almost. But the bottom line is that people get too emotional, and it's not emotional.
No, you said it right. I think let's get to the questions now because we have a couple minutes left.
I got about 5-6 minutes, and I got to drop.
All right. First question. We talked a lot about software, so I think it's a good one. What is our top 3 picks in SaaS right now? I can go first. I have already said Palantir. Clearly, Palantir. They're the best. I think Cloudflare is the second best. I think you have to specifically look at KPI metrics of which companies are experiencing reacceleration in the past 3 quarters. Cloudflare's RPO went from 39%, 43%, and this reported 48%. Clear beneficiaries of agentic AI. The third one, I'm going to leave it up to this earnings cycle. I've seen evidence from Atlas, MongoDB's Atlas, which is their cloud product, show a reacceleration in top line growth for 3 straight quarters. That's showing to me, okay, if they can maintain that, continue that, beneficiary. Snowflake, they showed it to 2 quarters ago. Net retention revenue increased for the first time in 3 years. Last quarter, it stabilized and increased. This quarter, I need to see a reacceleration. If I don't, this is not a cheap stock. It's pretty expensive compared to the other comps. I might have to have some tough decision making with that name. But to answer your question, it's Palantir, Cloudflare, a tie between Snowflake and Mongo. We'll see. What's your take?
Yeah, I mean, I think everyone will agree on Palantir. There's a reason it's maintained its premium and its multiple. I like your theme on security. A lot of times I think people forget to talk about security when we're talking about software because it's specialized. But as we've seen, one of the biggest vulnerabilities that have come out of all of this craziness of Moltbot and fast-paced disruption is that there's a lot of security holes that are left open. So I do see an opportunity for companies to come in here. On the others, some of the ones are boring, and I don't know, but I've said Oracle. I like, a lot of people, but I think Oracle is such a critical system of record, their core software layer. It's I don't see it being ripped and replaced. I don't see any evidence of that happening anywhere. And so even if AI continues to scale, these core business systems, I don't see them being taken out. So, that, and then, like I said, I've always had a soft spot. I do think Control Tower and ServiceNow is a rule of 55 growth company right now, working side by side with AI labs. So I do think that one's sticky, and they continue to show great numbers quarter in, quarter out.
Yeah,
and it's come down in price. It had a huge premium, and now it's really pulled back.
Yeah, that's a good question. So that was a good answer. So next one, does CrowdStrike get disrupted, or are they able to be agile enough to create more business verticals? I think CrowdStrike is tier 1 cybersecurity. I think they've proven the ability to continue to create internal modules without having to acquire their way to get new latest and greatest in AI security. Palo Alto has obviously adopted the land and expand business model that Salesforce did during the cloud era. On the AI security layer, you're seeing Zscaler make acquisitions. But I will say CrowdStrike's made multiple acquisitions recently. So I think that security is one of those highly fragmented industries. You don't see a lot of them because they're private markets. I think there's going to be a consolidation. But in theory, agentic AI is only going to increase the data security needs. It's such a tailwind. doesn't matter. The digital products that are going to get created from AI agents is going to be 10x, 100x, and it's just you need to secure those data, and you're not going to like AI agents or yesterday's AI will not provide cybersecurity components. They won't. It's very difficult. It's not worth the dying on that mountain. So I think CrowdStrike does not get disrupted. However, you have to talk about valuation. This is probably a top 4 valuation among software right now. So there's a premium, and I think they're still anchored by that outage from 2 years ago. It's going to take maybe a couple more quarters to get away from that shadow. But when that does, maybe we see a reacceleration, but it doesn't get disrupted. High bar, range bound for a while, probably their stock price.
Hey, Shay, there were a lot of people asking about your hedges. A lot of people are asking about the show. What do you do? Maybe talk a minute about that, knowing that, the volatility is moving all over the place.
Yeah. So, okay. Hedges specifically. Let's talk about QQQ. Clearly, you guys know 21-week EMA level is my favorite level. If we break that, this has been the character trade we've maintained for years in this market. If we break that, it's character changing. So where do I buy my hedges? I love anchored average VWAPs. If you guys don't know about that, it's whenever there's a black swan event, we finally bottom. There's usually a flood of new buying behavior that occurs at massive bottoms on black swan events. And this anchored average VWAPs reflects the average volume and price that people participate in this stock or ETF like QQQs while we bounce. So we broke through 21-week EMA level. Where am I going to buy my hedges? Right now, the anchored average VWAP from what's the last black swan event? Terraforce. April 7th, 2025 was the massive bottom on that black swan event. Anchor my VWAP to that level, and that level is at 570. So what am I going to buy for my hedges? 575 QQQ puts. I like to do 60 to 90 days in advance. I know a lot of people like to do near term. For me, I like to do 2 to 3 months ahead. I have my 570 anchored average VWAP. I think if we violate this level at 606, that might be a magnet at that level because there is a gap there. So buy 575 puts. Usually do around 2 to 3% position size on these puts. And my stop loss is always the 21-week EMA level. So if we close back above 21-week EMA, I cut my losses. But if we don't, I have a hedge, and then I typically sell the hedge if we get so bad. If the VIX gets in the mid 30s to 40s, so usually that's capitulatory to me, and I just I'm off. I got my hedges in, and I have an increased cash position now because I profit on my hedges, and I usually put those cash position towards my high conviction names that are on discounts because the market's very fearful right now. So hopefully that answered your question. And I think that we are at time. That was a good way of ending it. Yeah,
we are at time, and we will try to do more of this each week. Sometimes I guess we get into our little zone, and then but we do appreciate all the people chiming in, asking questions. Man, I had a crazy day today. I just do, but it's always fun to start Friday with you, Shay, and with all you out in the community. So appreciate everyone.
Yeah, tune in next week, guys.
We'll see y'all later.